So much of our lives, like the economy and the concept of money, and even our bank system, is based on trust. The trust that the bank system and the economy will hold up. But if that trust in the bank and the economy isn't there anymore, and people start to doubt, then what really happens? Unfortunately for Silicon Valley Bank, this is exactly what happened. And whatever you think about the situation, there's no question about it that this is a very big deal, as it is the biggest bank failure since 2008 crash and the second largest crash in the United States. So what happened to you, SVB, and will it spread to other banks? I'll tell you everything that you need to know, and at the end, I'll tell you exactly what you need to be doing with your money right now and where to put your hard-earned cash. What is SVB and what is Silicon Valley Bank? To provide a brief background of SVB, Silicon Valley Bank was the 16th largest bank in the United States, and by the end of 2022, SVB held around $209 billion in assets and $175 billion in deposits. And the reason why you might not have heard about SVB is that it was very specialized banking services for high growth startups and venture-backed firms, not a typical bank like JP Morgan and Citibank. And to put into some context, SVB was used by nearly half of VC-backed best startups in the United States, and even 44% of venture-backed technology and healthcare IPOs from 2022 were clients of Silicon Valley Bank. So let's say if a startup is looking for a commercial loan, a bank would actually request information about the company's cash flow as well as their available collaterals. And even for a young company without a cash loan, you still need a banking services like handling your employee payrolls and extending you lines of credit. And SVB did just that for startups and VC-backed firms, which is type of like a high risk, high reward type of business model when other banks didn't really want to take those risks on. However, SVB would develop relationships with companies super early during their growth, which really paid off because Silicon Valley Bank eventually grew to be one of the largest commercial banks in the US. And it saw a major growth during the pandemic, especially between 2019 and 2022, when it nearly tripled in size and rising from the ranks from 34th largest bank to the 16th largest. So what caused the eventual collapse? With the massive growth of SVB, similar to other banks, it would actually start using those significant amounts of deposits and assets to buy treasury bonds and other long-term debt. So these are known to be a relatively low risk, but also with low returns, while keeping a small amounts of those deposits in cash. But starting in mid-2022 of last year, Federal Reserve started to increase interest rate in response to the high inflation that was happening in the economy. And Silicon Valley Bank just became riskier investments. And since other investors could now buy bonds at a high interest rate elsewhere, SVB bonds declined in value. While this was happening, some of the SVB customers, many of whom are in the tech sector, were impacted by the financial troubles and massive layoffs like you typically see with Amazon, Facebook, and such. And they started to actually start withdrawing those money from the banks. So as more and more tech customers started to ask for their deposit back, SVB had no choice but to start selling the bonds at a loss for liquidity purposes. And it came to a point where SVB actually sold $21 billion of bond portfolio and realized $1.75 billion in loss from the sale. And so on March 8th, SVB actually announced to investors that it needed to fill this gap that it lost by raising capital with the plans to sell both common and preferred stocks to bring in $2.25 billion. But this announcement actually backfired by sending customers and investors into pretty much panic mode and caused a run on the banks, and which actually caused an even larger numbers of customers to simultaneously ask for withdrawals from their deposits. And it was reported that there was a withdrawal of $24 billion. Within a short time period of 48 hours only, SVB collapsed, which forced the federal government to stepping in and protect and reserve the public's trust in the bank system and prevent other banks from failing and helping customers to recover all funds, including that was insured and uninsured by the FDIC, which is Federal Deposit Insurance Corporation. However, investors of SVB stocks and debts weren't covered and lost their money completely with the collapse. And on the next day, on March 9th, shares of SVB tumbled 60% on Thursday after they announced a plan to raise more than $2.2 billion in capital. But the stock actually dropped another 60% in the pre-market on Friday, which is March 10th, before all trades regarding SVB were halted and never reopened for trading. Before I go into what you should be doing with your money, if you like this content so far, make sure you subscribe and like this video, as this is the best way to support my channel and the content that I try to produce. Now, at this point, it seems like panic has subsided and the dominoes were stopped before it spread to other banks. But we have yet to see how the future will play out, with possible recession coming this year in 2023. And that is still yet to see. So we don't actually know how this is going to really play out and if other banks might follow suit. But what should you do with your money to keep it safe at this point? I would say to put your money in one of two places. First option is the one that I personally am doing myself, and that is putting your money in a high yield savings account like Ally Bank, which is an online bank that I personally use. And they offer a higher interest rate than traditional saving banks. And these accounts are actually FDIC insured, where the government will protect your money up to $250,000 in case of another bank failure. And the second thing you could do, kind of similar to this, is to put your money in a CD, which is certificate of deposit offered by the banks or credit union. And they just require you to deposit money for a set period of time, for example, half a year or a full year, in exchange for a higher interest rate. CDs are also FDIC insured, but you can't actually withdraw that money until the term is up, or else you would have to pay some type of penalty. And even with these two options, even if you have over $250,000 in the bank, FDIC insures up to $250,000 per depositor per insured bank. So you could actually break up your money with other banks, and you could even have a joint account and share that account under two names, so you could actually double their coverage at $500,000. So I hope you guys enjoyed that and found it helpful. And as always, thanks for watching, and I'll see you guys in the next one.